Yes, good morning students. And we have discussed in the last video regarding the introduction to LPG, liberalization, privatization and globalization, which was implemented in new economic reforms. So hope you remember the background of new economic reforms also. In 1980s in India there was a great crisis, economic crisis happened, and we had a $7 billion of shortage, and we had a import balance pending, payment pending was there, and we need to pay for other countries also. Our foreign exchange reserve was very less. So what India approached, we had approached to the two international financial institutions, which are International Monetary Fund and World Bank. Okay, they sanctioned our loan facility with some condition. So that condition only implemented as a liberalization, privatization and globalization. Liberalization, which means giving greater freedom to all economic agents, and privatization, which means reducing the role of government sector and increasing the role of private sector. And next one, globalization, opening up of home economy into foreign countries. So about this, how it came into India or implemented in India, we have discussed in last class. Now we are going to discuss about the liberalization measures in detail. Okay ma? Now the term liberalization denotes removing restriction from certain private individual activity typically pertaining to economic system. Commonly, liberalization is used in the context of a government relaxing its previously imposed restriction on economic or social policies. Okay, so liberalization is a measure, the government removing its restriction on all economic activities. Okay, before there was a restriction on all the sector, not only a particular sector, for example industrial sector, financial sector, tax, trade and investment sector, etc. So many sectors was under control of government, because so hope you know we got our independence on 1947. So after that everything came into the sole government, which means democratic country. So the government decided, okay, before it was handled by so many people, so that's what our resources and all gone out. So we have to make a single authority power, and they have to control the entire economy. So like that they had decided. So our government was taking the care of it. It's not a domination, it's a kind of welfare activity. They thought if we give again to the private sector, again country welfare or country growth cannot happen. So it was under the control of government because of the British rule. Okay, so 1947 and 50 and all what happened you have studied. So that's what they had so many restrictions on industrial, financial, tax and trade reforms. Okay, trade sectors. Later on, after the 1980s crisis, India approached the international financial institution, and they made some condition. They made some condition. Then, as per the conditions, we have to follow. So the first rule is liberalization. The government should reduce their rules or restriction on all economic activities. So which are the activities they implemented? First one we are going to discuss about the liberalization measures. So removing the restriction on all economic activities. Okay, so here which are the liberalization measures we are going to discuss now. See here, industrial sector reforms, financial sector reform, tax reform, foreign exchange reform and trade policy reform. So these are the reforms, which mean these are the economic sector. We have done some changes. What are the changes we have done? The government has done. We are going to discuss in detail. See, number one is deregulation of Indian industries. What do you mean by deregulation of Indian industries? So hope you know the meaning of regulation, which means restriction on the Indian industries. There was so much of restriction on Indian industries to set up a new industry, private sector especially, to set up a new industry or expansion of the industries and fixing the price for their products and imposing more taxes on industries and licensing system. So many rules and regulations was there for the setting up of new industries. So it will curtail the economic growth, isn't it? If the private people are voluntarily coming together and set up an industry, yes, of course, they produce the goods and services, they will self-satisfaction, which means self-sufficiency will happen in India. Instead of borrowing or importing the goods and services from foreign country, we can produce with ourselves, isn't it? But this was not possible before the new economic reforms. So whenever the private industries are ready to come forward to produce, so many restrictions made on the private sector industry. So this was not good for the country growth. That's what the international financial institution saying, if you are growing only, you can able to repay my loan. So you have to follow my rules. So that's what deregulation of Indian industries. Deregulation is the reduction or elimination of a particular reduction or elimination of a conditions which is adopted by the companies, government, reduction or elimination of the government rules which is imposed on industries, which was entirely removed to develop the industries. Okay, the number of industries reserved for public sector has been removed from 17 to 2. Okay, so except the few important industries like automobile industry, this one defense and railway sector, and some of the very essential product, for example this arms and ammunition. So these kind of industries are very essential for a country. If they give to private sector, it won't be safety for the country. That's what, except the few industries, all the industries are given to the private sector. So number of industries reserved for public sector has been removed from 17 to 2. Atomic energy and railway transport. Rest of the industries was allowed by the government to private sector. Okay, so you know that private that time what happened? So except the few industries, the remaining industries were transferred to private sector. Next one is industrial sector reform. See here, industrial sector reform, what happened? Same thing only. Industrial sector reforms are included. Abolition of industrial licensing. So whoever wants to, the private sector industry, whoever wants to set up an industry, they can start. And abolition of industrial licensing, which means they removed the licensing system for setting up. Once you want to set up an industry, you can set up an industry. After setting up, you have to make up papers, which is what kind of products I am going to produce, what is my investment, and what kind of ingredients I am using, what are the quality control measures, which means pollution control measures I am adopting. So all the documents you have to submit. That is on later. So next one, restriction were removed on expansion. As I said before, 1980s there was so much restriction on expansion of existing industries. This also removed. And reduction in the reservation of public sector. Yes, the public sector reservation was there for all the industries, so it was removed from 17 to 2. Okay. Next, financial sector reform. See, the financial sector reforms, so the financial sector was controlled by RBI through various regulations. So, the aim of this financial sector reform is to reduce the role of RBI from regulating the financial institution, which means before 1980, the head of the country was, you have, hope you okay. That was the second year syllabus. So RBI, Reserve Bank of India, and financial sector in India are the two main monetary authority. So these two authority only was controlling entire financial activities of commercial bank, nationalized bank, or A to Z banks, commercial banks. Okay, so before they were imposing so much of a restriction, which means the commercial banks wants to fix a rate of interest for the deposits or rate of interest for the loan or whatever they want to fix. They have to get a guidelines or instruction from the RBI. Okay, entirely it was dominated by RBI before 1991. So later on, what they have decided, we should not always control the commercial bank. We have to give the freedom to the RBI bank. Instead of instead of imposing so much of regulation, we can be a guider, advisor, and support. Friendly environment they have to make. So they decided they decided to remove so much of restriction on the banks. Nowadays, the commercial bank, they can fix the rate of interest on loans and deposit as per their financial reserve status. Okay, so this is the financial sector reform. So here, See, objectives of banking sector reform: to make Indian banks internationally competitive, to bring structural changes in Indian banking system, to enhance the stability and efficiency of Indian banks, to remove the operational rigidity in the credit delivery system. So these are the main objectives of financial sector reform. So RBI was not only the supporter but also guide, okay, guide for all commercial banks. So this was the major financial sector reform. Okay, ma, in 1991 there was a financial sector committee, Narasimha committee. Under the committee they have implemented so many financial reforms. They have changed the cash reserve ratio, statutory liquidity ratio, open market operation, bank rate, everything. About this we will discuss in second PU later. What do you mean by cash reserve ratio, CRR, SLR? So these things and all are there. If the bank wants to get a instruction or a support from the RBI, they have to, commercial bank, they have to keep certain amount of deposit with the RBI. That is known as cash reserve ratio. So what, obviously whatever the commercial bank deposits, they get a rate of interest for their deposits from RBI. That amount is known as bank rate. And statutory liquidity ratio, which means the certain amount of gold and assets, which means shares, bonds, in these forms of liquidity assets, they should keep with themselves. They should keep with themselves, banks, commercial banks, with themselves as a security. Okay, this is known as statutory liquidity ratio. So these things and all was decided before by RBI. Now it's not decided by RBI. Okay, ma. And here you see which are the financial sector reform. The major reforms are: banks are given freedom to fix their own interest rate, and this reform led to the establishment of more private sector banks. Yes, after 1991 only in India so many private sector banks and international banks also have come. Okay, even foreign banks are allowed to function in the country. The commercial banks are allowed to expand their branches. Foreign investment limits in bank were raised to 50%. And foreign institutional investors, which means FII, such as merchant bankers, mutual funds, are allowed to invest in Indian financial markets. So these are the major or key points of financial sector reforms. Next, we are coming to the third reforms of liberalization measures: tax reforms. Hope you know the tax is, it is the payment made by the people, deliberate payment made by the people without any direct return, okay, without expecting direct return. Obviously there are many types of taxes are there. One is direct tax and indirect tax. So the people compulsorily they should pay, but they can't expect directly from the government return. That's what we are getting, the so many government welfare facility indirectly. This amount only the government will be using for welfare activity. See, these reforms are related to the reforms under government taxation and public expenditure policy. As I said, the government get revenue through taxes and spend as a expenditure to the welfare activity, okay, for the welfare activity. So there are two types of taxes are there. One is direct tax, another one is indirect tax. See, direct taxes. These taxes are the taxes in which the tax burden cannot be transferred on others. Yes, of course, if I am earning, I should pay the tax from my salary. I can't impose or transfer my taxes on others. Why I am saying this kind of things? Because there is an indirect tax also. Producer, they will pay the tax for the production or sales or trade business activity, but the tax amount they will impose on the customers. How they will impose? They will fix they will include the tax amount. They will share the tax amount in the price. Okay, that's what including MRP you would have seen. Maximum retail price, which means including of all taxes, it would have mentioned in a wrapper, product wrapper. So the product taxes and all known as indirect taxes. So but income tax is direct tax. Those who are income owner, they can't transfer the burden to others. So these are the taxes in which tax burden cannot be transferred on others. Before 1991, there was more tax evasion because of high rate of income tax. Since 1991, the income tax was reduced substantially. This has encouraged the savings. See here, before 1991 there was a more taxation was there, it seems, which mean for everyone there was a equal taxation was there. So later on it was changed to progressive taxation. Progressive taxation means you will pay more tax when your income increases. You need not to pay whatever you earn the income. Okay, before there was a tax system, equal tax system was there, which means if I earn 200 also I should pay equal 1% of tax, and if I earn 20,000 also equal tax, and 2 lakhs also equal level of percentage from my salary. So it is injustice to that income earner, isn't it? Wage earner. That's what evasion. Evasion, which means cheating or escaping from the tax payment. People was try to avoid the tax payment because of this injustice. So after 1991 the government decided we have to fix the progressive taxation system, which means you have to pay when your income increases. When your income is low, you need not to pay. There is a tax slab is fixed. Okay, now at present how much tax slab do you know, for male 5 lakh per annum, and for female 5 lakh per annum, for male 7 lakh per annum, or 5 lakh per annum. So there was a tax, there is a tax slab. If you cross the tax slab per annum in your income, you can't, you have, if you cross the tax slab you have to pay the taxes. Okay, next indirect taxes. These are the taxes in which the tax burden is transferred to others. Indirect taxes is imposed on goods and services. Many indirect tax rates on goods and services have been replaced by value added tax. See, at present VAT, value added tax, has been replaced by goods and services tax, which is GST Act of 2016 to simplify and introduce the unified indirect tax system in India. Okay, next, foreign exchange reforms. In 1991, to solve the balance of payment crisis, the rupee was devalued against the foreign currencies. This led to the increase in the imports, exports and inflow of foreign exchange reserves. Okay, foreign exchange reform, you know that what do you mean by devaluation, which means reducing the rupee value in terms of foreign currency, is known as devaluation of currency, Indian currency. The government devalued the Indian currency in 1991. So the foreign exchange reforms are devaluation of Indian rupee. This increased the inflow of foreign exchange, and market determination of exchange rate, trade and investment policy reforms, etc. And dismantling of quantitative restriction, which means importing of goods and services and export to other country was restricted before through the quotas and tariff, that was removed right now. And reduction of tariff rate, removal of import licensing procedures and export duties removed. So these are key points of foreign exchange reform. See, the deliberate reduction in the value of Indian rupee against the foreign currency is known as devaluation of rupee. Devaluation reduces the prices of export and increases the prices of import. So what will happen? People will export to other country more and import less. So before, the government was controlling the rupee value against the foreign currencies, but now the government allowed the market forces to determine the rupee value against the foreign currency. Now at last we are ending with the liberalization reform with the fifth reform, liberalization measures. Number one, fifth reform is reforms in trade in investment. See, trade in investment. Here this reforms includes dismantling of quantitative restrictions on imports and reduction of tariff taxes, removal of licensing procedure for the importable goods, except in case of hazardous or environmentally sensitive product. This kind of product, if they want to import the product, if any industry in India, they have to get a license. Okay, and quantitative restriction on imports was also fully decreased, and export duties have been removed because to encourage the export to foreign countries. So the domestic industrialists, they get encouragement to produce more goods more, and they export more. So when they export more, they will earn more. Okay, so here under the reforms in trade and investment, we had two main important things which are quantitative restrictions are tariff and quota. See, what do you mean by tariff? Tariff is nothing but it is the tax imposed on goods and services of importable items. Okay, the tax imposed on importable goods and services so this will discourage the import of domestic industrialists or domestic consumers, because when you start importing more and more from foreign country, what about our Indian currency? The outflow of currency will be more. Okay, so we don't get interest to produce ourselves. So self-sufficiency is must. That's why the government impose more taxes on importable items. So it will become costly. For example, if you are importing the Java bike or Royal Enfield or some other or Apple phone, 50,000, 100, 50,000, 60,000. Why? Because including of all taxes, the import duty also included in the price of products. So this will discourage the importable product purchases. So the government imposed more taxes on importable item tariff and quotas, which mean quantity of a goods that can be imported, which mean the government fix the limited quantity, so much amount only you can import the goods and services from foreign country. If they are fix the quotas, the government or industrialist or consumer will import more quantities of goods. Okay, so what will happen? They will permanently depend on foreign country instead of producing domestic. So these are the quantitative restrictions. This also removed or reduced the level of quotas and tariff are removed or reduced after the 1991 new economic reform. So these are the liberalization measures. I'll go through again. What do you mean by liberalization? Reducing the role of government in all economic activities, giving greater freedom to all economic activities. Which are the liberalization measures? Which is deregulation of Indian industries, financial sector reform, tax sector reform, trade reforms, and foreign exchange reform, trade and investment reform. That's all, ma'am. Thank you all. Keep learning.